IVV and SPLG are both exchange-traded funds, ETFs, that track the performance of the S&P 500, offering broad exposure to the 500 largest publicly traded companies in the U.S. While both funds serve the same purpose, there are a few differences that could influence your choice depending on your investment strategy and needs. IVV, or the iShares Core S&P 500 ETF, is one of the most popular and widely recognized ETFs for tracking the S&P 500 index. It's managed by BlackRock, one of the largest asset management firms in the world, and it's designed to provide investors with exposure to large-cap U.S. stocks. IVV has a low expense ratio of just 0.03%, making it an affordable option for long-term investors. The fund is highly liquid, meaning it has a large number of shares traded daily, which makes buying and selling easier for investors. SPLG, or the SPDR Portfolio S&P 500 ETF, is also an S&P 500 ETF, but it is managed by State Street Global Advisors. SPLG offers similar exposure to IVV by tracking the same S&P 500 index, but it comes with a slightly lower expense ratio of 0.03% as well, which is the same as IVV. While this may seem like a minor difference, for large investors, every basis point saved can add up over time. Like IVV, SPLG also offers broad exposure to large-cap U.S. companies. When it comes to performance, IVV and SPLG are quite similar since they both track the same index. However, IVV tends to have a slight edge in terms of performance due to its larger size and higher liquidity. Larger funds like IVV typically experience less price fluctuation and better tracking of the index. On the other hand, SPLG, being a smaller fund, may experience a bit more price volatility, though the difference is often minimal. One of the main differences between IVV and SPLG lies in their size and assets under management, AUM. IVV is much larger, with more assets under management compared to SPLG. This could impact liquidity, as a larger fund like IVV tends to have tighter bid-ask spreads, which means you're more likely to get a fair price when buying or selling. SPLG, while smaller, still has decent liquidity, but may not be as easily traded as IVV in terms of volume. Another factor to consider is the dividend yield. Both IVV and SPLG distribute dividends quarterly, but because IVV is slightly larger, it may have more consistent dividend payments. SPLG, being smaller, may experience some variability in its dividends, although this is often minimal. When it comes to cost, both IVV and SPLG are very competitive. They both offer the same low expense ratio of 0.03%, meaning they are both cost-effective options for investors looking to track the S&P 500. The difference in cost comes down to the fund's structure, size, and overall efficiency. In conclusion, both IVV and SPLG provide excellent exposure to the S&P 500 index with low expense ratios, but the best choice depends on your individual preferences. If you value liquidity, larger size, and potentially more stable performance, IVV might be the better option. However, if you are looking for a smaller, less expensive option with similar exposure to the S&P 500, SPLG could be the way to go. The choice between these two funds is very close, and ultimately, it comes down to whether you prioritize liquidity and size or prefer a slightly smaller, more flexible fund.